Let me turn to the special chapter this year on central banks and payments in the digital era. This year's special chapter follows in the footsteps of the earlier chapters on cryptocurrencies and on big tech in finance of the previous 2 years. And if you recall, those two chapters focused on what digital innovation meant for money and the payment system. There is also a strong technology theme this year, but our focus is broader. The special chapter this year highlights the central bank's role in the payment system. The focus is on what the central bank can do in putting in place a fast, efficient, and cost-effective payment system, and how technology can help. You can see from the cover slide that we have made a very long and substantial progress over history in how technology has helped central banks put in place such a system. But the key theme of the chapter is that technology by itself is not sufficient. The underlying economics and the nature of competition in the payment system are also important. The good news is that new technology will help central banks put in place the pieces more easily. Before going into the details, I should put my remarks in the context of the pandemic, which, as Agustin notes, is a defining moment for the global economy. In some respects, the pandemic has accelerated trends that were already underway. One example is the use of contactless payments, shown here on this slide, and also remote payments for online transactions. Both were rising before the pandemic, but the pandemic has given them further impetus. Also worth mentioning is the use of cash. Cash use for transactions has fallen, but the precautionary holding of cash has gone up. This is broadly consistent with past episodes of economic uncertainty. But one very important issue that Agustin mentioned earlier is the efficiency and timeliness of the disbursement of government fiscal support to individuals and small businesses who have suffered most from the pandemic. As this slide shows, governments around the world have reacted swiftly to put in place fiscal support measures, including direct transfers to households. Announced budgetary measures add up to 10% of GDP in advanced economies and 3% of GDP in emerging economies. Funding and guarantees come on top and are of comparable size to these budgetary measures. But actually reaching the affected people has been another matter. Some countries have been able to harness technology to reach those in need swiftly, for example, through disbursement into e-wallets and direct transfers to bank accounts. But the record here has been mixed. One problem is that not all those affected have bank accounts. And in some cases, even those that do have bank accounts have to wait for paper checks to arrive in the post. In the future, central bank digital currencies, or CBDCs, could be a means of expediting this type of payment, and I'll get to that later. Another issue is the cost of payment services. For credit and debit cards, it is mostly retailers and merchants who bear the costs through charges to the card networks and to the banks. The charges shown here in purple are from a European Commission survey. It's for a 25 euro transaction, and the horizontal axis here measures the cost in euro cents. The consumers don't always see these charges, but they can add up for the economy as a whole. Technology has certainly helped to lower costs. That's the good news. But technology can't solve everything. The costs also have to do with the underlying economics and the nature of competition in payment services. Payment services are a good example of an industry with strong network effects. This means that the more other users flock to a particular platform, the more attractive it is for a new user to join that same platform. Social media and messaging are good examples of such network effects. As we discussed in the special chapter last year, big tech firms with existing customer bases have entered payment services by using their advantage in access to user data. Once they reach a dominant position, They can create bottlenecks for competitors or raise fees for retailers. In this respect, network effects might be a mixed blessing for users. On the one hand, network effects can generate a virtuous circle of greater user participation, lower costs, and better services. But if all this leads to greater market dominance that eventually reduces competition, then users may ultimately end up being worse off. Let me explain with the example of competition between two full-service department stores, rather like these two here. You can see that the one on the right has become much more popular than the other one. The two department stores offer the full range of goods, but once inside, you cannot access the goods sold by the other department store. This is rather like competition between two payment platforms. To use a different analogy, closed networks that exclude competitors are rather like a walled garden. It's nice inside at first, but once inside, you're cut off from the outside world, and you may end up being trapped. In contrast, imagine a town square that sets up in a public, imagine a town market that sets up in a public square, like this one on Marktplatz, here in the center of Basel, just in front of City Hall. Unlike the full-service department stores, when you're in an open market in the town square, a buyer can have access to all the sellers without artificial barriers. A marketplace like this one brings together buyers and sellers. The buyers come to the market because they expect sellers to be there, and sellers come and set up their stalls because they expect to find buyers there. In this slide, shoppers enter looking to buy cheese, which in turn makes the market more valuable to the sellers of cheese, here on the left. The arrows in this slide indicate the mutually reinforcing nature of the buyer and seller participation. The more buyers arrive, the more the sellers set up their stalls, and vice versa. Another way to say this in the terminology of industrial organization is that there are strategic complementarities between buyers and sellers, where greater participation by one group brings greater participation by the other group. The same effect holds for the buyers and sellers of fruit and vegetables, fruit in the middle, vegetables on the right. The sellers compete on the price and quality of their produce, so you may think that sellers are worse off when there are many sellers. But this is a market for differentiated products, and buyers of cheese are also potential customers for vegetables. If buyers come for one good, but then also buy other goods, the sellers actually benefit from having other sellers in the market. So in this slide, the arrows at the top indicate this network effect between the sellers themselves. The entry of new sellers can benefit other sellers, even though they compete with each other. These network effects mean that when all these buyers and sellers come to the market, they add to the bustling and vibrant nature of the market, which is a public good that benefits everyone. And notice the contrast with the department stores. But the important point is that the open market relies on the rules and standards that preserve a competitive level playing field. The town square is a public space where buyers and sellers can meet without artificial barriers. But in return, the sellers have to stick to the standards laid down by the public authorities and allow the virtuous circle of greater participation and better services to take hold. So what does all this have to do with the payment system? Well, the analogy with the payment system is that market stallholders are like payment service providers, each offering their particular bundle of services that comes with basic payment functionality, such as e-commerce, messaging, and social media. Just as the market stallholders have to stick to standards, laid down by the town authorities, these payment service providers need to stick to various technical standards and data access requirements through open APIs in order to allow a competitive level playing field. The key concept here is interoperability, where the platforms offered by the payment service providers can talk to each other and work seamlessly for the user. Now, in this context, the central bank can play the pivotal role as the operator of the underlying infrastructure, much as the town authorities operate the town market. It is the central bank that provides the public space through access to its settlement accounts, and in that sense, the balance sheet of the central bank is a public space where the sellers of the payment services all interact. The central bank is well placed to play this role as it issues money, which is, after all, the unit of account in the economy, as well as ensuring finality of payments through settlement on the central bank's balance sheet. Like the town market, the central bank can help safeguard this bustling payments marketplace where the network effects can be channeled towards achieving a virtuous circle of greater participation, lower costs, and better services. This slide illustrates the role of the central bank as an operator of the underlying infrastructure. As you see in the blue line, beginning in the 1980s, central banks rolled out real-time gross settlement, or RTGS, systems for wholesale payments. And these systems are now very well established. More recently, a growing number of central banks have played a key role in the development of retail fast payment systems, shown here in the red line. Fast payment systems often allow settlement directly on the central bank balance sheet or through public utilities overseen by the central bank. And as you see in the red line, the diffusion of retail fast payment systems is following the same trajectory as the adoption of RTGS systems. Central bank digital currencies, or CBDCs, can be seen in this broader context. CBDCs are another way in which central banks can play the role of the operator of the payment infrastructure. Wholesale CBDCs may be similar to existing central bank settlement accounts, but recent discussion has been about general purpose or retail CBDCs that give access to claims on the central bank to ordinary users in digital form. The reasons for considering retail CBDCs are numerous and vary across jurisdictions. A survey last year of 66 central banks revealed that the safety and efficiency of domestic payments are the most important motivations. Also, many cited the decreasing use of cash and the need for financial inclusion as a motivation. In some respects, retail CBDCs represent an incremental step. After all, users already have access to cash, which is a direct claim on the central bank. On the other hand, retail CBDCs may represent a more far-reaching change in the nature of the relationship between the central bank and society. For instance, depending on how the CBDC is designed, there will be some kind of ledger that keeps track of transactions so that the central bank can honor its obligations to the rightful owner of the CBDC. In such a setting, safeguarding personal data would present new challenges. We may also expect CBDCs to have an impact on the functioning of the financial system, potentially leading to a much larger footprint of the central bank on the financial system itself. For all these reasons, the overall consequences of retail CBDCs will need to be weighed up carefully to gauge their likely benefits and costs. Now, if we look at the long arc of history, the institutional arrangements that support the monetary system has undergone many changes over the centuries. With the possible introduction of CBDCs, we may be at the cusp of another important leap in that journey. Digital innovation has made central bank public goods more important than ever, and central banks need to be at the cutting edge of technology to serve society. The BIS is supporting these efforts through its committees, through economic research, and through the activities of the BIS Innovation Hub.